The U.S. China trade war appears to be escalating into a standoff covering the entire economy as well as national security. Given the enormous pressure the conflict is placing on the Chinese economy, it is necessary to carefully analyze the impact on both the Asian and global economies. The full effects of the retaliatory tariffs launched by the two economic powers have yet to be felt, but China's stock market is already stagnating, reflecting concerns about the future. A careful eye must also be kept on the yuan, which is hovering in a low range. Washington has refrained from calling China a currency manipulator, but President Donald Trump has nevertheless been pointing an accusing finger at Beijing's foreign exchange controls. China's real gross domestic product rose 6.5% on the year for the July to September period, down 0.2 percentage points from the previous quarter. GDP growth has now slowed for 2 consecutive quarters and logged its weakest performance since the first 3 months of 2009, when the Chinese economy was struggling in the wake of the global financial crisis. Though exports remain solid thanks to a weaker yuan, consumer spending, long the main engine driving the economy, appears to be at a turning point. Chinese sales of new cars fell 11.6% in September, marking the third straight month of year-on-year decline. Prices have trended upward in recent months due in part to the new tariffs, with the consumer price index rising 2.5% on the year in September. One major concern is a possible hike in food prices, such as those of soybeans, nearly 90% of which China imports to cover its needs. To keep foreign companies and investors interested in China, Beijing has taken steps to ease investment restrictions. Thanks to such moves, a foreign automaker was for the first time allowed to own more than 50% of a joint Chinese company. While we applaud actions like this, they are the exception, rather than the rule. There are still many de facto restrictions on foreign ownership. Meanwhile, deep-pocketed Chinese companies continue to snap up foreign businesses that possess top-notch technology. Now that China has risen to the status of the world's second-largest economy, it should stop unilaterally enjoying the benefits of the free trade system and market mechanisms that exist outside its borders. It is time for the country to fulfill its obligation to become a full-fledged market economy where Chinese and foreign companies coexist on a level playing field. Only then can the economy of not just China, but the entire world, be truly stable. There are many problems with the Trump administration's policy toward China, not least of which is its penchant for serving only at its own interests. Trying to meticulously balance trade between two specific countries, the U.S. and China, for instance, is extremely difficult in this age of free-flowing global capital. China is not without its own problems, of course. It is woefully tardy in liberalizing capital transactions. Even governments that are critical of the Trump administration share our hope that China achieves true reform. At the upcoming fourth plenary session of the 19th Central Committee of the Communist Party, the Chinese leadership is expected to set out the country's economic policy direction. The communiqué to be released after the meeting will be worth a close watch, as it will outline the concrete measures China plans to take in the face of its worsening relations with the U.S.